It absolutely is. So when you look at the historical 4-year cycles, there's why 4 years? Because halving typically happens every 4 years, right around that time frame. And we've seen that during those 4-year cycles, there's when the halving is about to happen, that's the bear market. People start getting scared as to what's going to happen, and you see right after that it's plateaus. And a year out of the halving event, typically it starts to go up. Now, what this time it's different is you have Bitcoin adoption by sovereigns that did not exist previously. So I will leave that to the imagination of your investors and users, what you want to make out of that. We're bullish about it. If all these strategic Bitcoin reserves become a reality, you will see worldwide impact of this, and you will see with limited supply and a huge demand of those coins, imagine what that can do to the pricing.
This paradigm that we're in now is nothing like previous cycles. So I personally don't see us declining a lot and having that 4-year cycle. I think this is the beginning of a elongated spurt of growth, and that's really driven by clarity on the regulatory side, the US now being a leader, the US wanting to be a Bitcoin superpower. We saw on the stage yesterday that Pakistan has now decided to adopt a strategic Bitcoin reserve. And so one by one, I believe nation states will begin to do the same. This time around, you have Bitcoin treasury companies that are absorbing so much Bitcoin every single day. Miners are producing, approximately $50 million of new Bitcoin every day. But the amount of purchasing of Bitcoin, is in many magnitudes of that. And so supply and demand dynamics dictate that the direction is up.
So for 3 out of every 4 years, Bitcoin is generally the best performing asset. And each cycle gets subsequently smaller. So the previous cycle was a 20x from the trough to the peak. And now with volatility falling, if we kind of haircut that 20x and say maybe a 10x, then Bitcoin bottomed at 18,000, 16 to 18,000, depending on if you're looking at the hourly or the daily. You kind of get a range of where the technicals might start to really feel like they're overextended. And we use the digital gold analogy, and that framework is supported by consumer polling, especially in emerging markets, that shows that young people identify Bitcoin with digital gold. So about half of gold is bought for speculative purposes. The other half is used for jewelry or industrial, end markets. So over the medium term, we think Bitcoin could kind of approach that half of gold's market cap, which equates to somewhere around a 500K target. Maybe that's next cycle, maybe it doesn't happen, but that's one framework to think about.
I think the 4-year cycle is kind of up in the air in terms of how far we can get. We've never seen kind of the structural buying that we're seeing announced. Different public companies in the US announcing multi-billion-dollar raises for buys just in the next few months. Governments from the US, like David Sachs spoke to yesterday, to UAE, other sovereign wealth funds. It's tough to predict what's going to happen through the end of this cycle, but I think we're going higher.
We could see a kind of a slow climb up to say 200,000, driven by kind of marginal repricing of kind of the geopolitical risks and additional liquidity coming to the global system. And then I think the real bull market starts when you see these, I think 100, 200,000 wouldn't for me be a bull market. I think it's like just kind of climbing up to the overall liquidity in the system. And I think what will be the speculative kind of FOMO will be among these institutional pools of capital and even sovereigns.
In the past, until institutions were onboarded through the ETFs and the treasury companies, it is true that most of the Bitcoin trading was done at a retail level. And retail investors have a different time preference for how they think about profit and losses. But once you start bringing in investors like sovereigns, their time preference is extremely different. And they are not worried about 80% type drawdowns. They can hold for a lot longer as long as they believe it serves a role in their broader time horizon, which can be generations. And so those dynamics will ultimately buffer some of the volatility in the long run, both to the downside as potentially to the upside. but I believe most acutely to the downside, where you're not going to see these forced liquidations of retail investors being the driver of marginal price discovery versus the institutions holding strong. And that's what we've seen with the ETF flows.